Okay, so 2026 is bringing some massive tax changes. Like, we're talking new deductions, higher limit, different rules, the whole 9 yards. And here's the thing that nobody's talking about. None of these new tax breaks matter if your books are a mess. I'm Yelizaveta Taylor and I run Beyond Book Solutions. We do bookkeeping and fractional CFO work specifically for construction companies. And let me tell you, every single year I watch contractors leave thousands of dollars on the table simply because their bookkeeping wasn't set up to capture what their CPA actually needs. So today I'm breaking down the biggest 2026 tax changes in simple terms, but more importantly, I'm showing you exactly what needs to be tracked in your books right now so your CPA can actually use these new rules to save you money. Because truthfully, your CPA can only work with what you give them. And if your books are missing key information, then you're paying way more in taxes than you should be. So let's dive in. All right, so first up is the standard deduction. It's going up in 2026. If you're filing single, it's jumping to about $16,100. If you're married filing jointly, it's going to be around $32,200. And if you're a senior over 65, you get an extra bonus deduction of up to $6,000 if your income is under certain limits. Now, you might be thinking, cool, but what does this have to do with my bookkeeping? Everything. Here's why. You and your CPA need to decide whether you're taking the standard deduction or the itemized deduction, and you can't make that decision if you don't know what you spent all year. Let me give you a real example. Let's say you donated $15,000 to charity this year. You paid $8,000 in property taxes, you had $12,000 in mortgage interest. That's $35,000 right there. If you're married, that's more than your standard deduction of $32,200, and it's best to itemize. But here's the problem. You didn't track those donations in QuickBooks. If you didn't categorize your property taxes correctly, or if your mortgage interest is buried in some random miscellaneous category, then your CPA has no idea, and they'll just default to the standard deduction because it's easier. So here's what you need to do in your books. Create a specific account for charitable donations, track every single donation, cash, checks, even goods that you donate. Make sure your property taxes and state income taxes are categorized separately. Don't lump them together. Track your mortgage interest separately from your principal payments. Your CPA can't read your mind. They can only read your books. So make sure that your books are telling the right story. Okay, this next one is huge for construction companies, contractors, and anyone in real estate. First up, the auto loan interest deduction. Starting in 2026, if you bought a new vehicle for your business and financed it, you can now deduct up to $10,000 of interest you paid on that loan, even if you don't itemize. This is brand new, so if you bought a work truck, a van for your crew, or even a vehicle you partially use for business, make sure you're tracking the total interest paid on that auto loan. Your lender sends you a 1098 or a statement. Your business use percentage, if it's 80% business, you can deduct 80% of that interest. Your CPA is going to need this at tax time. If you finance $60,000 truck, paid $4,000 in interest, and you use it 100% for business, that's a $4,000 deduction you didn't have before. Second, the SALT cap increase. If you're in a high tax state like California, New York, New Jersey, or you just pay a lot in property taxes, listen up. The SALT deduction cap just went from $10,000 to $40,000. That means if you're paying $30,000 in a year in state income tax and property tax, you can now deduct all of it instead of being capped at $10,000. This is especially helpful if you own rental properties, have a home office, live in a state with high income or property taxes. So make sure your CPA knows your total state and local tax payments for that year. This could save you thousands. Here's what you need to do. Track your auto loan interest if you financed a business vehicle in 2025. Keep records of your property tax and state tax payments, especially if you own multiple properties. And then make sure your bookkeeper or CPA has clean records of these expenses by year end. And listen, I've seen this happen. A contractor bought a $70,000 truck, financed it, paid $5,000 in interest, and never told their CPA. They missed out on a $5,000 deduction. That's real money. Don't let that be you. All right, let's talk retirement because the contribution limits are going up into 2026. And if you're not tracking this in your books, you're missing out. For 2026, you can put up to $7,500 into IRA or $8,600 if you're over 50. You can put up to $24,500 into 401k as an employee. And if you're self-employed with a solo 401k, you could potentially get up to $72,000 to $83,000 into your retirement account, depending on your plan design. Plus, HSA limits are going up too. You can contribute $4,400 for self-only coverage or $8,750 for family coverage. And that's where the bookkeeping comes in. Retirement accounts have annual IRS limits, but business owners don't automatically qualify for the max. Contribution to IRAs, solo 401ks, HSA are often tied directly to net business income or W-2 wages. That means your CPA must rely on accurate books to calculate legal contribution amounts. If income is overstated, you risk excess contribution penalties. If it's understated, you miss out on major tax savings. Here's what you need to do. Make sure your business income and expenses are categorized correctly every single month. Don't wait until December to clean things up. If you're making retirement contributions throughout the year, create a separate equity account in QuickBooks called Owner's Retirement Contributions, so you can actually track how much you've already put in. Same thing with HSA contributions. Track them separately so your CPA knows exactly what you contributed when it's time to file. Your CPA can't guess. They need accurate numbers, and accurate numbers come from clean books. Okay, this is a big one, and honestly, this is where most contractors either save a ton of money or completely miss the boat. Bonus depreciation is back at 100% for 2026. That means if you buy qualifying equipment, vehicles, or tools for your business, you can write off the entire purchase price in the year that you buy it. Let me say that again. You can write off the entire purchase, not spread over 5 years, not depreciated slowly, all at once. I have clients who are making strategic equipment purchases at the end of the year specifically to offset their taxes, and it works, but only if your bookkeeping is set up correctly. Here's what your CPA needs to know: what you bought, description of an asset, when you bought it, the exact date it was placed in service, how much you paid, including any finance portion, how much you will be using it for business. It has to be more than 50% business use. Even if you finance the equipment and put zero money down, you can still take the full deduction, but your CPA needs documentation. Here's what you need to do in your books. You would create a fixed asset account in QuickBooks for every major equipment purchase. When you buy something, enter it as a fixed asset, not as an expense. This keeps your balance sheet accurate. Keep a simple note in QuickBooks with the purchase date, cost, and business use percentage. If you're financing equipment, make sure your loan is recorded as a liability and payments are split correctly between principal, which reduces that loan balance, and the interest, which is the expense. I've seen contractors buy $100K worth of equipment and completely miscategorizing it as supplies in QuickBooks. Don't do that. Here's a quick one that a lot of people don't know about. Starting in 2026, even if you take the standard deduction, you can still deduct up to $1,000 in charitable donations if you're single and $2,000 if you're married. That is new, and it's a great benefit, but only if you track your donations. So every time you write a check to a charity, code it as charitable donations in QuickBooks. Keep all donation receipts in the folder, physical or digital, so your CPA has a backup documentation. Okay, so we've covered a lot. New deductions, higher limits, new rules. Bottom line is none of this matters if your books are a mess. Your CPA is not a detective. They're not going to dig through the bank statements, trying to figure out what you spent on overtime or equipment or donations. They're going to look at your profit and loss report, your balance sheet, and your payroll summary. And if those reports are wrong, incomplete, or they're missing key information, they're going to file your taxes based on what they see. And you are going to overpay. I see this every single year. Contractors who make great money, bought equipment, paid overtime, they donated to charity, but because their books weren't clean, their CPA couldn't use any of it. So here's my advice: don't wait until tax season to fix your books. If you're doing your own bookkeeping, set aside time every single week to categorize transactions, reconcile accounts, and review your reports. If you're outsourcing your bookkeeping, then you got to make sure that your bookkeeper understands construction accounting and knows what your CPA needs, because at the end of the day, your CPA can only save you money if you give them the right information. So here's your action plan. Review your chart of accounts in QuickBooks. Make sure you have separate category for charitable donations, property taxes, mortgage interest, and any other itemized deductions. Then check your payroll setup. Track your equipment purchases as fixed assets, not expenses, and keep documentation on the purchase dates and business use. Reconcile your accounts every single month. Don't wait until December. Communicate with your CPA. Send them clean reports. Ask them what they need. Make their job easier. If you're a construction business owner and you're tired of overpaying on taxes because your books are a mess, that's literally what we do here at Beyond Book Solutions. We specialize in bookkeeping and fractional CFO services for construction companies. We make sure that your books are clean, accurate, and set up so your CPA can actually save you money. So if you want to chat, head over to beyondbooksolutions.com and schedule a free consultation. We'll take a look at your books and show you exactly what needs to be fixed before tax season hits. And if you found this helpful, do me a favor and hit that subscribe button and let me know what other topic you would like to be covered. See you in the next one.